So, you're a crypto millionaire, you don't want to pay tax, and you don't want it in your name. Well, in the next few minutes, I'll show you two methods how to do that. One is cheaper, and the other is how the ultra wealthy do it. So let's dive in. Now let's assume that you traded cryptos in your personal name. Since the blockchain is traceable, you'll need it ghosted. And the easiest way to do that is to just move it all into a Northern Cypriot company. Your home tax authorities can't even request it for your information because they don't recognize that the country exists. So basically, you'll end up with two options. Option number one is to keep your crypto profits liquid by going through a Northern Cypriot free zone company. And option number two is you can buy property and luxury goods with your crypto over there and enjoy a pretty decent life in the Mediterranean. But if you don't want it tied down into a property and you want it sitting in a bank account, you're going to have to properly structure a company.
But why do you need a company at all? Well, not just because it keeps assets out of your personal name, but it also lets you become more creative with taxes. Let's take an example here where you are making a very good salary of $1 million, just to make it simple. Well, all of a sudden, you will be first taxed and only then you can enjoy your money. Same thing for personal crypto gains. First, you pay capital gains, only then you get to enjoy your money. When it comes to businesses though, and we're talking about revenue here, first, you pay your company expenses. Usually it is rent, employee salary, supplies, equipment. But your expenses can become a little creative. Want the new S-Class Mercedes? Well, company car, need to impress the clients. Need the new iMac? Company computer. Need a Toomey bag to handle your company work documents? Company expense. And all of a sudden, your taxable amount shrinks. But can we get it as close to zero as possible?
Sure, if you have experienced, creative, and flexible accountants, professionals who can structure your business transactions properly and ensure that everything is correctly documented, then you can go beyond the simple tax write-offs. Basically, you need to construct a paper trail that tells a compelling story of your company's activities. This means documents such as financial statements, invoices, agreements, accounting records that all back up the legitimacy of your business transactions. And they all have to be crafted in a way that severs the chain between you and your crypto while still remaining compliant with all legal and tax regulations. On paper, your crypto isn't just sitting there. It's being used in a property development project, maybe a financial instrument or a loan between two entities. And in the free zone area, there is no capital gains tax as well as no income tax. From there, you can open a Turkish bank account for your company and cash it out into it with a paper trail and cloaked from your home tax authorities. So what happens if you don't do that? Screw the accounting, just wire it into your personal bank account. Well, what you'll quickly realize is that all banks communicate with one another. The moment that you wire, say, $1 million from a Turkish corporate bank account into your personal name in your home country, red flags everywhere. They're going to be starting to ask you questions on where did you get the money from? Is it taxable income? So if you don't want to deal with all that hassle, there is a far easier way. Just get a Dubai residency and buy properties and luxury goods. It won't be anonymous. It'll all be in your name, tied up in investments and not liquid. You won't be able to cash out your crypto directly into a Dubai account, but hey, you won't have to deal with companies or accountants either. Now, the second option, the one that the ultra wealthy actually use and has been circulating quite a bit online, is the crypto trust. Sounds simple, right? You just set up an irrevocable asset protection trust in Cyprus or the Cook Islands, plow in all of your Bitcoin, Ethereum, and meme coins, and boom, no taxes, and it's in the name of some offshore trustee. Not so fast. You see, there's a huge misconception online on what a trust actually does. Most people, they treat it like a personal bank account. They assume that just by handing over paper control to some offshore trustee, they can continue trading and investing like nothing ever happened. Oh, I'll just set up a trust, and if the tax man ever asks any questions, I'll just say, well, it's in the name of a trustee and they live in a zero tax jurisdiction, so none of the profits should be taxed.
Unfortunately, that won't hold up in courts. If you're still controlling the assets, the courts will rip that structure up in shreds and deem that the crypto was never truly transferred to the trustee in the first place. That's why the rich don't just rely on trusts. They build layers, a complex trust structure with a private foundation that creates enough separation between themselves and their crypto assets. Because here's the truth, trusts were designed to protect you from courts and probate.
not from taxes. What the rich figured out was that by adding a charitable component, they could continuously defer taxes by constantly being in debt.
So if you've set everything up properly, here's how it would work in practice. First, you start off with your trading company. It can be any offshore LLC. Let's use Belize for this example. And this trading company is owned by an offshore trust. Now here it's extremely important to have an army of lawyers and accountants to create enough separation in the eyes of the tax authorities where they do not deem the crypto to be still tied to you. Otherwise, this entire structure falls apart. Next, if you've already realized the gains on your crypto, basically you've sold them, you can move those profits back to your company through a loan from the charity trust. But if you haven't sold your crypto, you can do what many billionaires do, such as Michael Saylor, meaning you borrow against the crypto. What does Michael Saylor do? He has a bunch of Bitcoin that is owned by MicroStrategy, a company, not him, and he basically continuously borrows against it. And as I previously said, debt is not taxed.
Here's the most important distinction. The ultra wealthy, they never distribute the trust's assets because that would be a taxable event. They don't dissolve the irrevocable trust either. They keep everything inside, borrow against it, and keep rolling over the debt. The long-term plan, of course, is to eventually transfer it to the next generation tax-free and accumulate those assets. So unless you're paying over $300,000 in tax to your government, we suggest options such as Northern Cyprus. And listen, if privacy isn't a concern for you, there are even cheaper places to go, such as Dubai or Turkey, where you can cash it out in your personal name. Now, it won't be anonymous, and you're basically banking on these places to continue being tax havens for decades to come. And the way that Dubai increased the corporate tax rate to 9%, that doesn't seem likely at all. But the main takeaway from this video is that a trust is not your personal savings account. If you do not have an army of lawyers as well as the complex structure where you create that separation, it ends up being a glorified document that you can keep in your kitchen, but just like a poor man with a Bugatti, you won't be able to use it. Anyway, that's it for today's presentation. If you enjoy this type of content, be sure to subscribe and leave a comment down below because it helps with the YouTube algorithm. I just linked the previous video on how to cash out your cryptos if you don't have the source of funds, but I'll be seeing you in a future presentation. And until then, guys, bye-bye.